Hello and welcome to Trade Finance Talks. I'm Mahika Ravishankar, Deputy Editor at Trade Finance Global, and we're coming to you today from the Cybos 2025 conference in Frankfurt, Germany. Today I'm going to be talking a bit about fraud prevention and detection solutions in the modern age, and there's almost no better person to join me than Federico Aveyan of FCOM. Federico, thank you so much for joining us today.
Thank you, Mahika, for being here.
So to start with, can you tell me a bit about your background and your role within
Sure.
FCOM, and also what brings you to Cybos this year?
Wow, thank you. My background, I'm an engineer by training, and I joined FCOM as a provider for technology some 12 years ago, bringing to FCOM a piece of technology which had embedded AI into it. So basically, I was a vendor of technology to a technological company. After that, one of the founders of the company asked me to join the company to grow the company outside its core markets, Germany, Austria, and Switzerland. So now we're global. We're a global company, and I always kept that AI piece with me, and now it's part of, let's say, the DNA of the company as well. Why Cybos in 2025? Because we're headquartered just 10 kilometers from here, where we're sitting right now, in a smaller city called Neu-Isenburg, which is between the airport Frankfurt and Frankfurt City. We've never been here before, but being here local, and Cybos probably not coming back in a foreseeable period of time. So we thought, hey, this is our opportunity to be here.
Well, it's great to have you here and to be able to connect like this. You mentioned being ahead of the curve on AI, essentially, but I want to talk about traditional methods of fraud prevention first. What do these methods look like?
As you know, in the past, and let's maybe use the Lehman case in the past. Lehman was a company that was rated AAA for basically until the day it went bankrupt. So how can that be? An organization as large as Lehman being AAA, and the next day, zero, done, gone. So everyone was relying on past numbers, business reports and stuff, and didn't really pay attention to what was happening inside that company. I would say that this is still the case in between 2008 and 2025. We're talking, 13 years of difference? No, more, 17 years of difference. Most of the companies all over the world are still doing that, looking at data that's been passed, sometimes super passed, and relying on the nature of the quality of a company and their way of payment, the way they did it a year ago or 2 years ago. And we know that from ourselves that this is not healthy. If you go to have a doctor's check, and you rely on what happened 2 years ago, that doesn't mean that this is you today. So the vision here or the idea is, why isn't it possible to make an assessment of an organization in real time? I mean, today we're in the time of data being available all over. So this should not be like that. So what we're trying to do is virtually going away from those old assessments, what companies do today, still do, into something more up-to-date, real-time.
So when companies are trying to put together this data assessment, what are some common blind spots which they often miss?
Everything. I would say blind spots are everywhere in an organization at the moment where you haven't, or from the time you took the picture. So maybe the picture is a good analogy, because you take a picture and at that moment the picture is historic. So from that moment on, it's not that organization anymore. If we look into the area of the space where we work in factoring, where a factor purchases receivables from an organization, from a company, one of the blind spots that you have is how real is this particular receivable? Is it a receivable that's authentic? Is there any substance in it? We call it could be something that is fraudulent, so the factoring is not really having any content it's not having any asset inside. And at the same time, it could also mean that maybe the relationship between buyer and seller is not good. So we call that invoice may have some sort of dilution. So dilution is an important blind spot in factoring. So you may purchase an invoice for a face value of 100 euros, for instance, and at the end, maybe you are getting paid 100, but maybe you're getting paid only 90, 80, 70, 50, and maybe nothing. So the difference between 100 and any other value below is the dilution. And if that happens regularly, frequently, often, then you're not doing the business that you should be doing in factoring. So dilution is one of those blind spots.
So the points of dilution and questioning the validity of receivables ahead of time leads me on to my next question, which is that obviously prevention is better than cure. So how can factoring software help businesses identify and mitigate risks even before they become risks?
Right. And that was the idea that we had in our team. Our systems at EFCOM process around 200 billion euro per year at our client sites. So this is an enormous amount of money. It's about 5% of the global factoring volume traded and financed. So our systems have a lot of data. We're doing a good job in processing that data. But the question was, are we doing the right job? And probably the right job is, what is that data mean to us, to the factor, to our clients? And so what we did is, let's look into the data and let's see if the data is telling us something. And the data is telling us a lot of stuff. It's like your vital signals. So your pulse rate, your heart beating capacity and stuff like that. So if the vital signals are okay, in principle everything is okay. But what happens if the vital signals are changing? And we're talking about changing. And this is what we're observing in a customer's ecosystem using our application. Is there anything changing? And if it's changing for the goods, that's fantastic. But if it's changing for the bad, and what does it mean for the bad? It means with the historical data that we have from clients that we know, everyone who moved in that particular direction, in 99.9% of the cases, let's say, went insolvent. Oh, okay. Now if you're seeing a similar pattern from a particular customer or debtor in a factor's ecosystem, you would tell your client, or the application would tell your client, hey, look at what's happening. This is most likely going to lead for 99.9% of the ones that behaved like that, they went into insolvency after 3 months, 4 months, 5 months. So actually you could foresee in the future, like your vital signals, if they're changing for the bad, that something is happening that you should pay attention, maybe with some urgency or super urgency right now.
So it's kind of an assessment of where these things went wrong and then putting all of that data together?
Correct. And so past data is always important because it gives you some intelligence, backed with the intelligence, let's say, of individuals who know the industry quite well, so particular KPIs. But even independently of that, when you use machine learning, for instance, as an instrument for predicting what's happening in your ecosystem, then that particular KPIs may be irrelevant because our world is changing, and perhaps the KPIs from the past are not good for the present and the future.
I was about to ask, how transferable are these risks really? Because all the different shocks that are happening to supply chains are almost impossible to preempt.
Correct. And this is where AI comes into the game, or ML. It's taking perhaps parameters that weren't even taken into account before. But we're talking always about changes. And when changes become detected in the system, you try to figure out what does that mean. And that's when the alerts come up. And put into some correlation, and those are the messages that we can, bring into the game and alert that there is something that's going to probably make your life miserable. Yeah.
Thank you. I want to just finish by talking a little bit about regulation and how transparency and data privacy can be maintained and ensure businesses stay regulatorily compliant. As they're deploying these new softwares?
That's an excellent question, which we're trying to figure out ourselves. I understand the regulator trying to keep the privacy. When we talk about privacy, we always have to distinguish between, are we having the privacy between Mahika, Federico, absolutely guaranteed. Now, when it comes to privacy of organizations, companies, public entities.
And their vital signals, I guess.
That is a different thing where I think, we have to differentiate. I agree 100% that individuals, private individuals' privacy has to be kept. But when it comes to companies, it's a different thing, point one. Point two, what we try to do is use technology again, where we have some sort of ways of anonymizing, if you like, the data from particular companies or individuals. You can use blockchain technology, hashing technology, things like that, to make data intransparent for someone who looks at the data. So there are instruments that help, but all in all, you could also say we make systems that are encapsulated, that are not open to the outside world. So where you have a closed system, where the data remains inside, and the systems are telling you what's happening in your ecosystem without going to the outside world. So in that respect, we try to have these three things: so data itself, and then encapsulation of the data within a certain group, a company, let's say, so it doesn't leave the data to outside world. And that is also a way of privacy.
Thanks a lot, Federico. It's really given me a lot of food for thought going into the rest of the conference, and these are themes that I've heard in various panel discussions and in conversations I've been having with people. So thank you very much for joining me, and enjoy the rest of your week.
Thank you, Mahika, and enjoy your week too. Thank you.